Why Warren Buffett is holding $300 billion in cash. Warren Buffett, the Oracle of Omaha, the man who transformed Berkshire Hathaway from a struggling textile company into one of the most powerful investment machines in history. Today, Buffett is sitting on nearly $300 billion in cash and U.S. treasuries. That's more than the GDP of entire nations. But the question is, why? Why is Warren Buffett, a legendary investor known for buying companies at the right time, refusing to deploy this enormous mountain of capital? Is he scared of today's markets? Or is he patiently waiting for the next big crash? Buffett's cash hoard explained. As of 2025, Berkshire Hathaway has amassed an astonishing cash position close to $300 billion. This is the largest pile of cash in the company's history, and it's not by accident. Buffett has repeatedly said that he prefers to keep a large amount of cash on hand, partly as a safety net and partly as dry powder to deploy when real opportunities arise. To put this number in perspective, Berkshire's cash is larger than the market value of Disney, larger than McDonald's, and even bigger than the GDP of countries like Finland or Portugal. That's how massive this war chest is. Buffett's investment philosophy. Buffett's strategy has always been built on one principle: only buy when there's real value. He is famous for saying, "The stock market is designed to transfer money from the active to the patient." In other words, you don't win by constantly chasing every hot stock or following hype. You win by being patient, waiting for the right moment, and buying when others are fearful. Buffett has consistently avoided investing when valuations are stretched. He's not interested in chasing the latest tech bubble or trendy IPO. He focuses on companies with durable advantages, strong cash flow, and fair prices. And right now, he doesn't see much of that. Why hold so much cash now? There are three main reasons why Buffett is holding on to so much cash. 1. High valuations. U.S. stocks are near record highs. The S&P 500 and NASDAQ are priced at levels Buffett simply doesn't consider attractive. He has always said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Right now, he doesn't see those fair prices. 2. Rising interest rates. For years, holding cash or treasuries meant earning almost nothing. But today, treasury bonds are yielding over 5%. That means Berkshire can earn billions risk-free while waiting. It's like getting paid to sit on the sidelines. 3. Preparing for the storm. Buffett knows the cycle of booms and busts better than anyone. He's seen it in the 70s, the dot-com bubble, the 2008 crash, and the 2020 pandemic panic. He knows markets will eventually swing from greed to fear, and when they do, he wants to be ready with cash. Buffett's history with crises. To understand Buffett's cash strategy, you need to look at history. In 2008, when the financial system was on the verge of collapse, Buffett stepped in. He invested in Goldman Sachs, General Electric, and Bank of America when nobody else wanted to touch them. The deals were structured so well that Berkshire earned billions when markets recovered. In the early 90s, when Salomon Brothers faced a trading scandal, Buffett injected capital and stabilized the company. Again, he was rewarded for being the one with cash when others were desperate. In 2020, during the pandemic, Buffett made defensive moves. He sold out of airlines, avoiding years of losses, and instead parked billions in cash and treasuries. Many criticized him for missing the rebound, but Buffett was focused on risk management, not hype. The pattern is clear. Buffett hoards cash when markets are hot, and spends big when markets are in panic. What Buffett's cash means for investors? So what does Buffett's $300 billion cash hoard signal to ordinary investors? It's a red flag. Buffett doesn't see value in today's market. He sees risk. And if Buffett is unwilling to put money to work, maybe we should be cautious too. But there's also a lesson here. You don't always have to be fully invested. Sometimes patience is the best strategy. Buffett is teaching us that waiting, holding cash, and earning a safe return can be smarter than chasing overpriced stocks. Patience pays. The hardest thing for investors is to sit on cash. We live in a culture that tells us money must always be working, always invested. But Buffett shows us the opposite. His billions in cash are not a sign of weakness. They're a sign of discipline. Buffett knows that markets always cycle. Greed leads to overvaluation, fear leads to crashes, and crashes create bargains. And when that day comes, Buffett will strike, just as he did in 2008. Conclusion, the takeaway? Warren Buffett isn't hoarding $300 billion in cash because he's afraid. He's doing it because he's wise. He knows that the market doesn't always give you opportunities. Sometimes the best move is to wait. So the big question is, when the next crash comes, will you have the patience and the cash to buy when others are panicking? Buffett will. And that's why he's the greatest investor of our time. If you enjoyed this breakdown of Warren Buffett's strategy, make sure to hit the like button and subscribe for more deep dives into investing, finance, and the stock market. And let me know in the comments, do you think Buffett is right to sit on cash? Or is he missing out on today's bull market? This is Felix. See you next time.